All right, so as usual, this is Hybrid Accounts, and today we're just going to study IS 38. What is IS 38 about? It's about intangible assets, right?
Yeah.
Yeah, so maybe, when you speak of intangible assets, maybe you can just start one thing. There is something we call non-current assets, of which they could be tangible or intangible. Now you have to understand. When we speak of tangible non-current assets, these are current assets that can be touched. For example, let's say we have studied about PPE, investment property, things like that, right? And then we
Yeah.
have intangible non-current assets. Now, when speaking of something intangible, an intangible asset usually, when you just say the word intangible as it is, it could be monetary or non-monetary. And for monetary in assets that are intangible and they are monetary, it could be like investments in debt or equity, which are not under intangible asset standard. They are not under A38 as we speak. All right. They are financial instruments and they have their own standards. But when we speak of intangible assets, which are non-monetary, it's when we come into the context of what I was just about to speak of and what I38 is all about. So simply speaking, intangible assets are non-monetary assets without physical substance. When we say something is intangible, you cannot touch it, it's obvious that it got no physical substance, right?
Mm.
Yes, but what you have to note here is they are non-monetary. Because if an asset is intangible and it is monetary, it should not be actually classified as to be actually in I-38. That one is usually a financial instrument. It could be maybe, if you invest in shares or if you invest in debt in a particular company, actually investment in shares is not a tangible asset. It's not something tangible. It's intangible, but it is monetary, so it's not classified under I-38. All right. So simply speaking, the asset, to say that you have an intangible asset, the asset actually must constitute the following. So that you can say, oh, I have an intangible asset and I can recognize, I can have it in my books. First of all, the asset must be controlled by the entity as a result of events in the past. If you take a look at this one, it's just like the definition of normal assets, right? But also something, it should be something from which the entity expects future economic benefits. If you say you have an asset, that means you have something that we control and you expect future economic benefits from using it, right? So simply speaking, intangible assets could include the following. Something like licenses, quotas, all these are intangible assets. Maybe we can speak of intellectual property, like let's say patents, you have your mixture of making a certain product and no one is allowed to use that mixture, let's say for 4 or 5 years. That's what we call a patent. You can have a copyright. No one can copy your materials unless actually you're given permission. And then you could have brand names. The company developed the brand. Actually, the brand name sells. Help the company to sell a lot of goods. Let's say you can have trademarks. So all these are just examples of intangible assets. You could have goodwill. Goodwill actually see it even in consolidation of financial statements. We'll see it in much more details. Goodwill. And then you can have computer software, like the one you are using, Zoom. So it's just like that. Actually, example, there are a lot of examples of intangible assets. You can have mastheads, things like those, a lot. You can have a website. So objectives of the standard, what does the standard aim at? It aims at establishing the criteria for when an intangible asset may or should be recognized. You just need to know when to recognize an intangible asset, and now I can have all the criteria and find out whether they have been met or not. But also, actually, the objective of the standard are in specifying how intangible assets should be measured. So simply speaking, it's all about recognition, but also we have spoken of measurement here, right? When you recognize something, you must be able to measure it. So recognition, measurement, and then specifying the disclosure requirements for intangible assets. Disclosures. When you just have an intangible asset and you've recognized it, actually, you would need to give further information to the notes to the financial statements. So that's what the objectives are. And now you can just go on and check on the assessment of an intangible asset. How do you assess whether this is an intangible asset or not? There are factors that we usually consider. One, identifiability. If you speak of the word identifiability, we say that this helps to be able to separate it from goodwill. Let me show you one thing. Before proceeding, there is something very, very essential here before going further. If you have ever heard of how to determine goodwill in a business combination, if you go and acquire a certain business, you would have to determine the goodwill because a business may be worth 100 million, but actually maybe you have purchased it all, but you paid 120 million. Why did you pay in excess of something that does not actually seem to be the fair value of those net assets, of that equity? We say that actually that excess is what we call goodwill. It could be real goodwill or it could be a combination of other intangible assets for which you cannot obtain their value. Let's say there is a brand, but you cannot obtain the fair value of brand. What do? It would ultimately come and actually be part of the goodwill. So if you just take a look, we usually say that to obtain goodwill, it's like a company has gone to purchase the equity of a certain company so that they can control it. So let's say you have purchased 80% of the certain company. You can call it purchase consideration, or let's say investment cost. Let's say you have purchased 80%. If you've purchased 80% of the equity of a certain company, that means there is something you haven't purchased, which you call non-controlling interest. I'm just referring to consolidation here. Non-controlling interest, let's say something like this. So this is the equity that you find out in a company, but you did not acquire it. So if you add these two, this 80% and this 20%, you obtain the total value of the investment, 100% value. Now, what do we purchase? We purchase the net assets. Net assets, and by net assets, I simply mean equity. So if you purchase the net assets, we usually measure them at fair value so that we can really determine goodwill in a proper manner. So you just do it this way, and after this, you would obtain your goodwill now. This will be the goodwill figure, just like this. So you'd have a goodwill there, and everything would be over. So now, when they speak of the word identifiability, what do they mean? This one is net assets, which is equity, and equity means assets minus liability. Now, the good example, when dealing with a business combination in the consolidation of financial statements, we usually have actually to express this is net assets minus liability. All assets should be measured at fair value, and liabilities should be measured at fair value. Now, you can just ask yourself one thing. Let's say you purchased 80% by paying 100 million, and then maybe you determine that non-controlling interest, something that you do not have control, maybe to 30 million, I'm just supposing. In the net assets, which was actually equity, but actually it is adjusted for, this equity is usually adjusted for assets and liabilities at their fair value. Let's say the net assets was actually 80 million, just like this, 80 million, 80 million, just like this. If you had something like this, you'd have to determine the goodwill is how much? 100 plus 30, 130 minus 80, which gives you 50 million. So you'd have 50 million, just like this. And this one should be the goodwill, right? But now, not one thing. Let's say that there was a brand, the value of which, the fair value of which could not be obtained, and so we did not incorporate it here in the fair value. If we didn't incorporate it here, that's why you got the fair value, the goodwill of how much? Of 50. Now presume one thing. Presume that as usual, you purchased by paying 100 million. This non-controlling interest was 30 million, just as usual, but right now, you knew the fair value of the brand. Maybe brand had a fair value of 20 million, of let's say 25 million. If brand had a value, or let's say maybe a brand has a value of 15 million. If brand had a value of 15 million, that means that this fair value of net assets wouldn't have been 80. Rather, it would have been 95 million, just like this, right? This is what should have been the value. Now, if you less here, how much are you going to obtain? 100 per 30, 130 minus 95. This one is 35 million, just like this. Now, take a look here. Here we had goodwill of 50 million, but here we have goodwill of 35 million, just because in the first case, the earlier case, we are not able to determine the fair value of brands. Now you can see how goodwill can change just because you cannot identify something separately. Now, if you just consider this way, we find out that, oh, here I had 50, but here I had 35. But remember, there was 15 here. I've been able to distinguish the brand from goodwill. So intangible assets for which maybe during a business combination, I'm just taking an example, you cannot obtain their fair value would actually be incorporated into goodwill. So you can find out that, oh, so goodwill could be simply a combination of a lot of intangible assets just because we are not able to identify their value. So that could also constitute goodwill. I hope you just got the inner meaning of goodwill, and then we can proceed. So usually consider identifiability, just like you saw there, but also say to be identifiable, I-38 states that it must fall into one of the following. If something is identifiable, it's either separable, just like I showed you, let's say that brand name was separate. I knew the brand name had a value of 15 million. It was separable. But usually when you say something is separable, as a good example, it's when the asset can be bought or sold separately from the rest of the business, right? Maybe you have...
Sorry, Fred.
Yes.
Sorry, wait a minute.
Yes.
Now we're talking about intangible assets.
Yes.
Yes, but goodwill is a form of intangible assets.
Exactly.
Okay, so then why is the sentence here? This helps us to be able to separate it from goodwill. Is goodwill not part of the intangible asset?
Yeah, that's why I say that. You know, when we speak of goodwill is an intangible asset, but in some cases, it could actually be a combination of a lot of intangible assets, which you can just not determine their fair value, just like that.
Okay.
You can have a goodwill of 20 million, but within it, there can be a brand of 4 million, but since you're not sure of that value of 4 million, you just call it goodwill, right? Yeah. So we say that first of all, it could be separable, which is obvious. A computer software is separable. I can purchase a computer software. I can sell it separately without affecting other parts of the business, right? But also, that's why we say, oh, it arises from a legal or contractual rights. And this will arise as part of a purchasing an entire company, which I was just speaking of. You know, when we purchase an entire company, we say that we have made a business combination. Let's say you purchase a subsidiary and actually you have created goodwill. You have paid for much more than what the equity was worth at fair value. And so we mean that you have also purchased goodwill and you have to own that goodwill, right? All right. So by proceeding, we say the other assessments come from the normal definition of the asset. The other assessments actually are just normal. We actually saw them, right? What are the other assessments actually? We say control, we are already spoken of it. You should be able to control. You know, when we are saying that you are controlling something, what do we mean by that? First of all, the entity, the asset must be under control of the entity as a result of past events. We already spoke of that. If you have an asset, you're controlling it as a result of past events. Let's say you purchased, let's say you exchange it, so it's under your control. But when you say that you are controlling something, you must be able to enjoy those economic benefits and prevent others access to those benefits. That's when you say you are controlling an asset. You can enjoy those benefits, but also you can prevent others from accessing those benefits. All right, that's the second point. And actually, you are saying that a legally enforceable right is an evidence of such control. This is just an example. When do you control something? Oh, I've gone and purchased a computer software. I have a legally enforceable right to it. So it's obvious that it means that I'm controlling it. That's why you're just saying a legally enforceable right is an evidence of such control, but it is not always a necessary condition. Not necessary, but actually that's just an example. For example, let's say having control over technical knowledge or know-how only exists if it is protected by what? By legal right. Otherwise, everyone will be using that. But also, you say the skills of an employee arising from the benefits of training. You have trained your employees. Should that be capitalized an intangible asset or not? No. You cannot capitalize employee training, that skill of an employee, just because you have trained them and you say that you have an asset. Because they are unlikely to be recognized as intangible assets. Why? Because the entity does not control the future actions of its staff. Remember that we say to be controlling something, you should be able to enjoy the benefits. All right. If you have the staff, you would enjoy their skills, but actually prevent others from accessing those benefits. You cannot prevent others from getting services of your employees. So usually the skills of an employee should not be capitalized as an intangible asset. And the last point, we actually saw it there above again, expected future economic benefits. You know, if you have an asset, you can recognize, you can just say you have an asset if you really expect future economic benefits. Because if you don't expect any benefit now, how come do you call it an asset? What does it give you? So simply speaking, economic benefits may come actually from whatever, let's say from the sale of products. Maybe you have developed something and actually it can help you to sell products. You have a brand, it helps you to sell products, maybe from the sale of products or services, or from reduction in the expenditures. Let's say you have incurred development costs, and right now maybe you have the better technology. Maybe you have a better technology to produce something, so you might have saved costs. Or maybe you might have increased the production. You had a machine initially, but now maybe you have done something and you have increased the production. So it really depends on what you speak of. I just gave an example of the machine, but machine, is not an intangible asset. All right, so it's just like that, and we can proceed now on recognition. Because usually when we say an intangible asset, we expect to find under the statement of financial position that you have written something. Intangible assets may be equal to $5 million, $6 million, $10 million, just like that. So when is it eligible to actually incorporate an intangible asset into the statement of financial position? These things are usually the same. It's just like for PPE, it's just like for investment property, it's all the same. To be able to recognize something, first of all, actually, it should really be an asset. There should be probable future economic benefits, but also you can recognize something if you cannot measure it. Even if you know that, I have an asset, I expect future economic benefits, but okay, it's fine. But at how much are you going to recognize it? You start saying that, I'm not so sure. If not so sure, then don't do that, because it should be reliable. So an intangible asset, when recognized initially, must be measured at cost. It should be recognized if and only if both of the following occur. Obviously, on initial recognition, we recognize it at cost, just the same as for investment property, the same as the property, plant, and equipment. So it's just the same. So the first point, the first condition for recognition is that there should be probable flow of future economic benefits that are attributable to the asset. Simply speaking, there should be probable outflow of future economic benefits. You expect the benefits, and that's why you can say that you have an asset, but also you should be able to measure it. Otherwise, you won't be able to recognize it in the books. So the cost can be measured reliably, just like that. These are usually the common conditions when dealing with these non-current assets, like intangible assets, this one, and then you have PPE and investment property. All right, now just for proceeding, you can say management has to exercise judgment in assessing the degree of certainty. We're just trying to say the probable flow of future economic benefit. How do you know this is probable? How do you know it is more likely than not? So this is the duty of management, because they're the ones with the ultimate responsibility of preparing financial statements. So that's why you're saying actually they should assess the degree of certainty to check whether it is probable or not probable. All right, to the flow of economic benefits. And then we can proceed and note the following. First of all, if an intangible asset is acquired separately, its cost can usually be measured reliably. You know, this one becomes easier. You have purchased computer software, you have paid for it, so it's obvious that you would know the cost. That's why they say the cost can be measured reliably as its purchase price, which is obviously say you have purchased, including incidental cost of purchase. You know, you may incur some transaction costs when purchasing something, so you would capitalize them together. Let's say it's legal fees, right? And maybe any other cost incurred in getting the asset ready for use. You know, it's just like for PPE. Let me tell you one thing. You know, when we spoke of PPE, we say that there are costs that you usually incur to get an asset. There are purchase costs, maybe there are there could be import duties and other non-refundable taxes. In case you did that, in case you imported something like that. But for intangible assets, it really depends because say that I've imported something, then at the port maybe they charge me something, not like that. All right, so another point to note here is when an intangible asset is acquired as part of a business combination, now not acquired separately, part of a business combination, for example, an acquisition, the cost of the intangible asset is its fair value. I think I spoke to you about that. I gave an example how to determine goodwill there, right? And so when determining goodwill, we say that assets and all assets and liabilities of the subsidiary that you are just about to acquire should be measured at fair value. So whenever you acquire the business, if you have intangible assets, they should be measured at their fair value. Even if there are intangible assets or maybe there are liabilities which should not be recognized. For example, let me tell you one thing. We spoke of I-37, that is provisions, contingent liabilities, and contingent assets. When we spoke of contingent liabilities and contingent assets, we said that they should not be recognized. But really, when you are here, we say that contingent liabilities are usually recognized when it comes to the business combination, when you need to determine the goodwill. Why? In the books, they are not recognized, but let's be sure here. You go to someone, you need to purchase something, right? You need to purchase their business. For them to sell you their business, they say that, oh, there is a certain customer whom they have filed charges and they expect to receive a huge sum of money, although it is not probable, it's just possible. Maybe there is just a 30% chance that they will be paid. So when they sell that business to you, they know that, oh, what if they sell to you and actually you manage to win that case and that you manage to go to get that money? So they say that no, I cannot just sell to you this business without actually considering my contingent assets, or maybe they are contingent liability. I cannot stop considering them. I would have to consider them. So they consider them just like that, using fair value. So this is the main basis of how we do that. All right, another point, we say IFRS 3. This one, when you see something called IFRS 3, it is called business combination. Business combination when let's say a company is acquiring a subsidiary. So it says IFRS 3 explains that a fair value of intangible assets acquired in business combinations can normally be measured with sufficient reliability to be recognized separately from goodwill. Do you see this point now? If you can measure the fair value reliably, it would be separated from goodwill. For example, that $15 million brand, which I just showed you, and we are able to separate it from goodwill. If you cannot do that, it would be incorporated into goodwill. Yeah. And another point to note here is in accordance with IS-20. You know, IS-20 is all about government grants. There's a standard called government grants. We just go through it. Government grant is simple. Let's say that an asset is worth 50 million, but the government offers to give you 20 million, as long as maybe you would fulfill certain conditions. Let's say hiring some employee for at least 4 years, just like that. So they just help you. So actually, you might have the asset might actually have cost you 50 million, but maybe you have really paid only 30 million. So there are ways to account for those grants, which is not our concern here. But let's just get a point. In accordance with IS-20, intangible assets acquired by way of government grant and the grant itself may be recorded initially either at cost which may be 0 or at fair value, just like that. So it really depends. You can use cost and you can use fair value depending on what the information says. All right, now let's read this question. Let's just this is question 1. Question 1 says, how should the following intangible assets be treated in the financial statements? How are you going to treat the following intangible assets? A publishing title acquired as part of a subsidiary company. And then here we have a license purchased in order to market a new product. How are you going to do that? This is our solution, and we started the publishing title. Now read. A publishing title acquired as part of a subsidiary company. So actually you did not acquire it separately. It was just a contractual term that you acquired the subsidiary. By acquiring a subsidiary, that means you presume the responsibilities for all liabilities and assets of that subsidiary, right? So a publishing title, since it has been acquired as part of a subsidiary company, no problem. We said if you are doing a business combination, those assets and liabilities should be measured at fair value. So the first thing is, if the asset can be valued reliably, the title would be recognized at its fair value, just like that, just like we did for brand. You have a publishing title and you know that, oh, this publishing title has a fair value of $2 million. So what should I do? Just recognize it, no problem, but only at fair value. If you cannot get it at fair value, it's now read this one and would get what I said earlier. Otherwise, it would be treated as part of a goodwill on acquisition of a subsidiary. Now, do you see this? It should be as part of goodwill because it's, you know that it's there, but actually you got no sufficient justification to incorporate it into the books. So actually it will just be there, but actually it's part of goodwill. And then we have the license here. License purchased in order to market a new product. Now this one is obvious, you know, this one is not a business combination. We have purchased it separately. So it's obvious that I've purchased it. The cost can be measured reliably, obviously. So we say since the license has been purchased separately from a business, it should be initially capitalized and measured at cost. So this is how we can go about those initial steps. And let's say maybe there are several ways of acquiring intangible assets. What are those ways of acquiring intangible assets? Actually, it's not just intangible assets. I'll be going through both a lot of standards here. First, purchase. Purchase, even if you can also purchase PPE, you can also purchase investment property. So even if you are asked ways of acquiring PPE or investment property, you could have said this one, purchase. And that purchase could be separate or could be as part of a business combination, something we have spoken of already, and so even seen an example. So number 2, we say internally generated. You know, you can have intangible assets that are internally generated. When you speak of PPE, you can say that, or maybe investment property, you can say that maybe this internally generated is just like self-constructed. For example, you can have self-constructed assets. You construct your own machine, and you say it's self-constructed. But here we call them internally generated. Okay, but also you can have through you can acquire through government grants. The government actually offer to help you on how to acquire on acquiring something, but it just in return it just needs you to fulfill certain conditions, right? Then we have number 4 on exchange of assets. Exchange of assets, right? I think we saw this. Did you see this? The day we spoke a bit about this, but no problem. Exchange of assets. You know, we can have an asset and we can exchange with someone else for the other. But also you can acquire them to, oh, I've repeated government grants. I've done it twice. I didn't mean this. So we just have purchase. You can actually generate it internal. You can have internally generated. We can have government grants. We can have exchange of assets. There are a lot of ways here actually. So, you know, it's like when you are speaking of property, plant, and equipment, you could say that, oh, I could lease them. So, things like those. Let's say maybe you have obtained the right to lease something, and then you can do that. All right, so proceeding, we say if an intangible asset is exchanged for another, This one now is a very, very important point. It's called exchange of assets. If an intangible asset is exchanged for another, its cost is measured at fair value, unless the exchange transaction lacks commercial substance. This is the first point now. So note this always, whenever you exchange some assets, right? Whenever you exchange some assets, you use the fair value to recognize them. So unless the exchange lacks commercial substance, this is point number one. And by commercial substance, what do we mean? By commercial substance, we just mean that there is no future cash flow implications, let's say on risk, amount, and timing. You know, I usually like to describe the thing this way. When you say there is no risk, there is no actually future implications, just take this one. Present value equal to future value over, I think we did this under provisions, 1 plus R, and then we say how much? N. If you speak of the future cash flow implications, you know, to obtain the present value, say discount, you just discount the future value. When you speak of future value, you can just speak of those amounts. When you have this discount rate, you can speak of risk. And when you speak of this N, you can speak of what? This is just an example. When you speak of N, you can speak of, let's say, useful life, things like those. So that's why you find out those 3 points there. But also, as we say, let's say you have said you need to measure that fair value, but the fair value is not available. What can you do? You got no choice. So that's why we say you should measure that fair value unless the exchange transaction lacks commercial substance or the fair value of neither assets can be obtained. If you cannot obtain the fair value of neither the asset that you are giving up, but also the asset that you are just about to acquire, you did not know their fair value. So obvious that you won't be able to do anything, right? Okay. So otherwise, the cost is measured at the carrying amount of the asset given up. Meaning that if you have an asset in your books and you are giving it up to obtain something else, then there should be no changes in the books in case any of the following have failed, because by saying the fair value of an asset given up, that means that asset you are giving up should be in your books at that moment, right? Yeah, so that's one is very, very important. Okay, so just proceed here. The following is a priority now. The first priority is given to the fair value of an asset you are just giving up. You have an asset with a fair value of 8 million, but you are acquiring an asset with a fair value of 12 million. That's no concern. We are just exchanging, but you should remain the same way. So actually, you should measure that incoming asset at the fair value of your asset, the asset that you are giving up. So the priority is use the fair value of an asset given up. If it's not available, then you would have no means, rather than using the fair value of an asset acquired. And if neither fair values can be obtained, as you have just seen above here, then just use the carrying amount of an asset given up. So it's just easy, just like that, right? So we can just proceed on the next part and take a look at this question here. Now, this question involves issues of commercial substance. Maybe you can study it and see how